We wanted to make a video just on some things that people should keep in mind when refinancing their house. We have a lot of people looking to take advantage of the low interest rates and the increased valuations of their home. So we have conversations every single day about some things you should consider. So we wanted just to outline those for everybody today.
What is up, YouTube? Matt McKeever here, and in today's video we're talking about the tips and insights you need to know, the top 10 things when it comes to refinancing your real estate. Now, refinancing is a great way to get access to equity that would otherwise be locked up, and it's a really powerful strategy that myself and a lot of the investors I know regularly use. But today we're going to cover some insights that maybe you guys didn't realize. Smash that like button, hit subscribe, and let's jump into it. What is up, YouTube? Matt McKeever here, and we're back with the Findlay guys, Josh and Ehren. Hey guys, how's it going?
Good, man. Thanks for having us.
Good. So today we're going to be talking about 10 things that you need to know or take into consideration when looking at refinancing.
Yeah. So we wanted to make a video just on some things that people should keep in mind when refinancing their house. We have a lot of people looking to take advantage of the low interest rates and the increased valuations of their home. So we have conversations every single day about some things you should consider. So we wanted just to outline those for everybody today.
Yeah. First thing we want to take a look at is just how long have you owned the property. We know what the investors out there doing the BRRRR, the idea is to get in and out as quick as possible, but most of the lenders that we deal with have some sort of minimum period that they want to see a borrower in the property for. So I'd say on average the lender's looking for you to be in the property for 6 to 12 months. That 6 months is in and around the most average time. We have done some refinances at 3 months. It does get a little bit trickier. You are a little bit more limited. There's probably 1 or 2 lenders out there on the A and the B side who will consider it, right away. But they're still looking for, most of them, like I said, are looking for like that 6 to 12 month. Once you get away from the true institutional monoline and A lenders, there are some credit unions who can do a pretty immediate refinance. Really just comes down to showing how you got that valuation, that increased valuation, and if you can prove how you got it and they're okay with it, they're pretty good at doing that instant refinance as long as that appraisal comes in with the value.
Awesome. And it's pretty important for us to know exactly what our plans are with the refinance and the timing, right? So if we know we want to do it fast, we should probably be talking to you guys before we acquire it initially, right?
Yeah, exactly. And I know we talk about that 20K flip product that we have a lot too, where it's minimum or maximum 6 months really. One of the things that we talk about is be prepared if you're looking to BRRRR that property, be prepared to carry it for 6 months because you may not be able to exit out earlier than that. So, it could be an additional carrying cost that you have to take in consideration and make sure the budget has room for it that way. If you're only planning for 3 months and after 3 months you're losing money, you may not be able to get that refinance at the 3 month mark. So just making sure you have the cash to carry the project for the minimum length at that 6 month mark.
Yeah, the second thing you should consider is value increase. So moving off of what Ehren said, the reason why some lenders have a gestation period is because they need to be able to reconcile the actual value increase over a short period of time. Say you bought a house for $300,000 and a month later you're going, hey, Mr. Bank, my house is now worth $500,000. They're going to have some issues with that. So some tips and tricks to be able to approach a mortgage broker or a bank is take before and after photos. Be able to quantify why your house is worth more than what it is now. A lot of banks are, because of obviously the appreciation in certain markets, they're kind of questioning, even if the value comes in on an appraisal, like they're not comfortable with moving forward on a deal anymore. So being able to prove how you force appreciated that asset is going to be really crucial if you're looking to complete your refinance in a short period of time.
Holding on to your quotes, holding on to the receipts, being able to show the lenders how much money you put into there. Like Josh said, just quantifying and actually having proof that it was forced appreciated. Lenders aren't as likely to give you a larger equity takeout if you bought a property and then a month later just shot up through market appreciation. They don't really like that. So being able to show that and prove that definitely helps get the transaction moving.
Third thing to keep in mind is how does your refinance affect your cash flow? So a lot of people understand that you're going to take money out. It's great. You can use that money to invest, but people don't crunch the numbers in the back end and realize that larger loan amount is going to increase to a larger monthly payment, which is actually going to increase or decrease your overall cash flow on the property. So if you're a cash flow investor and you're only looking for cash flow, tapping into that equity, is going to affect your overall long-term strategy. So something to weigh and consider.
Yeah, especially right now with rates being so bottom of the barrel, when you're refinancing a year later, in most circumstances, those rates are probably going to go up a little bit. So, not only are you taking out a larger loan amount on the back end, you're also probably taking out a loan with a slightly higher increase in rate as well, too. So, those two things can definitely impact your cash flow, and you might see a decrease in the monthly cash flow as well. Who holds the current mortgage? So this is something that we have to look at every time. Is it a private mortgage that's currently on your property? Is it held by an institution, or is your property free and clear? There's 3 different outcomes that are going to come from each of these situations. In the past and currently, we're seeing a lot of lenders hesitant to just give free equity takeout if it's coming out of a private mortgage. Most of it has to do with the anti-money laundering. They want to know where that down payment came from. Being able to track that definitely helps with the ability to take out equity on the refinance. A lot of the refinances that we've done, the lender wants all the proceeds to be lawyer directed. So they're looking to have proceeds go right towards some sort of bill payment, taking out mortgages. They just want to see that it's going somewhere other than directly into your pocket, which is a little tricky for a lot of the bird guys, because being able to use that money right away is the whole idea. So, having a purchase and sale agreement lined up would definitely help, because again, the lawyer can hold that in trust and put that into a trust account for the purchase. Having a plan and being able to get at that private is especially more important.
Yeah, and kind of thinking about that overall principle of why lenders are the way they are is the reason they want to see it go into another financial asset, let's say, is in the hopes that you're staying as financially strong or getting stronger by getting those proceeds, rather than say just going and spending it on consumer things and consumption.
Yeah, their main thing is can the borrower maintain their payments? And if they give you $300,000 in debt and you go out and you're buying a car, you're buying a boat or something, and it's going to increase your monthly liability, they don't want to put the borrower in a position that's going to increase likelihood of them defaulting on a mortgage payment. And the big thing for investors to focus, like you said, is how the lender perceives things, because that's the important part. Is the lender who's providing the money. You got to understand how they work and how they think, and be able to position your documents and your mortgage in line with the way the banks think.
Yeah, fifth thing to consider is, does your mortgage have a bona fide sale clause? So, we see a lot of these no frills under 1% mortgages offered, and what people don't understand is that these are quite literally no frill mortgages. They don't have prepayment privileges. You might have a bona fide sale clause, meaning you have to sell your property. You can't break it unless you pay a huge fee to the lender. So it doesn't always make sense to get the lowest rate possible if you're going to be handcuffed into your mortgage product. So, understanding what current product you're in and what fees are going to come with breaking that product. If you do want to refinance, it's better to understand before you start the process, and until you get to the bank and your payout statement says you owe $20,000. Could be a little bit of a shock.
Yeah.
Yeah, and something to clear with that too is if you get a 1-year term and it is a bona fide sale, you can refinance on renewal, but it's breaking that mortgage in the term that the lenders have an issue with. So. The sixth thing is, what type of mortgage rate do you have, or what type of mortgage? Is it a variable rate? Is it a fixed rate? Is it a fully open term? Each mortgage is going to have different types of exit penalties for that mortgage. So with a fixed rate mortgage, borrowers are looking at an interest rate differential or a 3 months interest penalty, and there can be a pretty big difference in the exit penalty between those two. So the interest rate differential is essentially the difference in interest that you would pay based on that future rate. So if you're in a 5-year rate and you want to exit out in that first year, the lender's going to take a look at what your current 5 rate is and then what a 4-year rate would be, and then look at the difference. So depending on how rates are moving, if rates are going up or if rates are decreasing, you're going to see a change in your interest rate differential penalty. If rates are increasing, the lender isn't going to be losing out on that additional proceeds, because they're actually refinancing you back in at a higher interest rate. So you might have a little bit less of an interest rate differential penalty. But if rates are decreasing and now you're breaking out of your current mortgage and getting into a lower rate, that means the lender's going to be missing out on some funds. You're probably looking at a much higher interest rate differential. And we see some of these IRD penalties, $20,000, $25,000, depending on how long your term was and how much of a principal you have outstanding on the refinance. Variable rate or I guess fixed rate, the last is 3 months interest, and it's always going to be the larger of the two. So even if the interest rate differential is favorable, but the 3 months interest penalty is greater, they're going to take the greater of the two penalties on the fixed rate. Variable rate, standard 3 months interest, depending on the lender. Some will do it based off of your contract rate that you have. Some will do it based off the Bank of Canada's prime rate. So you could have a 1.45 on your contract, but Bank of Canada's 2.45 on the prime rate. You know, some lenders may go off that 2.45, some may go off your 1.45. So just making sure you have a firm understanding of how that bank calculates it, because, you know, even that situation, you could be looking at a couple $1,000s difference in the penalties. So. And then lastly, fully open. Not very many lenders offer that type of product, but in a fully open product, there is no interest penalty to exit, but you are looking at a little bit of a rate premium because the lender knows you're probably looking to get out of that early. They're going to juice the rate up a little bit to try to grab as much money on the interest as they can while you're still in the mortgage.
Number 7, use of funds. So what are you going to use the funds for? At the end of the day, as Ehren said, and we kind of said previously, you know, the lenders are going to want to see what you're using the funds for, or ask you at least what you're using the funds for. If you are pulling out like $200,000 for a renovation, it's quite possible a lender will ask you for a quote to fix your house. Or if you're going to go blow it all in a car, you know, they might actually not let you have it. There are a handful of ways in which a lender might mitigate the overall risk of giving you cash. They may have it directed either whether that is another purchase of a property, or whether it's to a line of credit or to some debt. One of the things that they do allow us to do is to pay out debt from the advance of the loan to reduce ratios. So say you had a bunch of credit card debt and some unsecured line of credit debt that was affecting your overall qualification. We could actually pay that debt out of the advance of the loan to lower your overall GDS-TDS ratios and allow you to qualify for the loan. So it's a handful of ways in which we can use the debt to creatively help people in certain situations. And some lenders, depending on the lender, have max equity takeout requirements. So some lenders are capping it at $75,000. Some have a $200,000 limit. It really depends on who you go to and what their, I guess, risk tolerance is for giving out just large amounts of cash.
Yeah. Number 8 is like, what are your goals? Like, what are you looking to do down the road? Are you looking to acquire more property? Are you looking to have a open line of credit that you can utilize? Basically, what we're looking for is like, what do you need from this refinance? If you're just looking to pull out cash, you know, a full refinance is going to be the way to go. That's going to give you the most amount of equity takeout. You know, you can do a 75 to 80% equity take or loan to value and pull out the equity. If you're looking to have some sort of flexibility and a line of credit to be able to draw from, and you don't want to start making those principal and interest payments right away, maybe looking at refinancing into a product that has a HELOC attached to it is the way to go as well too. You know, if it's your first property that you have, you know, we always recommend getting into the HELOC as soon as possible, just because with the way they qualify, having the least amount of monthly liabilities makes it easier on the qualification process. So, you know, just what are your goals moving forward? What do you need? And that's going to allow us to set you up with the best product and moving forward and helping you align with your goals.
Number 9, fees. Everybody wants to know about what it's going to cost to do it. The great thing about a refinance is a lot of the fees get absorbed in the cost, so you don't actually pay them out of your pocket. They get eaten out of the loan, and then you get paid the difference. There are a few fees to consider. You do need to use a lawyer to close your transaction. I know some people don't understand that. You don't, because you're not purchasing. Why would I need a lawyer? They do need a lawyer to close because they need to register a new charge on title, which is important. So you're going to have a lawyer fee. You're going to have a appraisal fee. So you're going to have to get the new value of your home. And if you're with an A lender, there probably isn't going to be any lender fee or broker fee. But if you're trying to stretch your ratios and you can't necessarily qualify with an A lender, you might be able to pull out more capital with an alternative solution. And there may be a broker fee or lender fee involved if you're looking to maximize your overall equity takeout availability.
Mm-hmm. I think that's an important part too, is something to take a look at when you first get into that property is, can you afford the refinance on the A side? If you're buying it on the A side, or on the refinance, are you going to be looking at going into a B lender because you've increased the property value so much? You know, if you're thinking you're not going to have any lender broker fees on the refinance, and all of a sudden you're stuck at 2%, that can be a bit of a shock for some people who weren't expecting that. So making sure you can afford that refinance on the A side if you're purchasing A is a pretty important part to begin with when you're purchasing the property. A standard versus collateral charge for point number 10. There's two different types of mortgages a lender can register on the property. The first and the most common is a standard charge, where if you're getting a mortgage of $400,000, they register $400,000 on the title. A collateral type charge mortgage is often seen usually on the small business side or on the credit union side. But I know Scotia and RBC are actually pretty good at putting a global limit on a property. And essentially what they do is they register typically at like 125% loan to value, and it allows the borrower to be able to increase that limit or increase that mortgage balance without having to re-register the charge. So you still have to get an appraisal on your property and confirm the value, but because the lawyer's already registered 125% on the property, you don't have that secondary lawyer cost when refinancing the property. So it can be a good way to save some fees on the back end if you know you're looking to do a pretty immediate refinance within 6 months to a year, and you just paid, a couple $1,000s in lawyer fees. Being able to save that $2,000 on the refinance can put a little more cash back into your pocket.
Yeah, and the other thing obviously being how much are we trying to refinance too as that, right? Because if we're going to go past that 125%, then we're going to end up breaking it again.
Yep, 100%. Yeah, having that initial conversation with the lender, what are you comfortable registering at? If you have a pretty strong feeling your ARV is going to be $250,000 over that purchase price, talk to the lender, see what they're comfortable with and going. And if they can stretch that value and make sure it fits, then perfect. We can save you on those costs. If they can't, well, then you're still looking at paying those legal charges on the back end.
Mm-hmm.
Yeah, last but not least, we threw a bonus one in here, which is private collateral. So some of our clients, what they do is they use built-in equity in other properties as almost like cash for purchasing other properties. And what we'll do is we'll cross-collateralize those assets to help with the down payment source. Mm-hmm. Now, if you've cross-collateralized those assets, say you bought a property for a charge for $1 million in the property you have, and you have a first and a second on your other property, that second charge is still going to be $1 million. So you're not going to be able to refinance that property that you've used as collateral until you actually deal with the initial property that has the initial $1 million charge. So if you are using your assets as collateral for a down payment for another property, just keep in mind that you can't actually refinance out of that until you deal with the initial charge on the front end.
Yeah, really important we map out the sequence of events there, right? Because timing's everything in that regard. So yeah, definitely a novice investor can get themselves into trouble with collaterals without understanding it if you haven't just mapped it out. But it's actually a pretty simple thing. Just when do we plan to dispose of the asset or refinance it? When are we going to need to grab any new equity from it?
For sure, yeah. Having that foresight and to be able to plan maybe 1 year, 2 year, 5 years down the road and figure out, my renewal is this date, but I actually need to refinance before the renewal because if I have a charge here, my bank end up seeing that first charge or the second charge of my property, you may have an issue with renewing that initial mortgage that you had with your bank.
Yeah, and making sure that ARV value is going to be there. If you come in short on the refinance and you can't pay out that whole charge with the equity takeout, you're fronting that out of your pocket to be able to cover the rest of that difference. So definitely making sure the valuation is going to be there. And if not, you better have a bit of a cash reserve from some other source to be able to cover the difference on takeout.
Awesome, guys. Well, I love it. And again, refinancing is a very valuable strategy for us as investors. But one of the biggest struggles is just the fact that a lot of new investors don't really understand the nuances. Hope you guys now better understand the nuances. Josh and Ehren's contact information, as always, will be in the video description down below. Definitely reach out to them. You guys are always happy to chat.
Always.
Yeah, always, yeah.
Awesome. So again, reminder, they've also got their own YouTube channel where they produce their own YouTube content. Make sure you jump over there, give them a sub, check out, dive deeper into financing your Canadian real estate projects, and looking forward to having you guys on the channel again.
Yeah, looking forward to coming.
Thanks again to Josh and Ehren for breaking down the top 10 things that you guys need to know or that they find a lot of their customers don't realize when it comes to refinancing your real estate transactions. Again, if you're looking to BRRRR, if you're looking to flip to yourself, or maybe you're just looking to tap the equity in a property that's appreciated significantly over the last few years, that's essentially every single Canadian that owns real estate at this point in time. I hope that you got value from this video. If you did, smash that like button, hit subscribe if you're new to my channel, and you can jump over and actually watch other videos from Josh and Ehren. They've started their own YouTube channel. We'll throw a link in the video description down below. Really encourage you to jump over. We always love supporting other great Canadian content creators. Thanks, guys.